SurePoint Advisors is an investment advisor in Brielle, New Jersey. SurePoint Advisors is registered with the Securities and Exchange Commission. Registration of an investment advisor does not imply any specific level of skill and does not constitute an endorsement of the firm by the Commission.
Welcome to another episode of SurePoint Advisors Financial Roll Call with James Fay. We are 10-8 in service. This is a podcast for law enforcement by law enforcement. I am James Fay. I'm a retired law enforcement officer and now financial advisor with SurePoint Advisors. I'm focused on helping law enforcement officers make educated financial decisions that will directly affect their retirement. I truly believe that this podcast will help accomplish that. All right, today we got a very special episode. We have a special guest today. Earlier in the week, I got to interview Jason Lamb. For those of you who don't know, Jason is the CEO and founder of SurePoint Advisors, and SurePoint Advisors is his vision. He takes great pride in educating his clients or his prospective clients, and it's never more evident than you'll witness today when you hear this interview with him. His passion and his conviction in educating our listeners is evident when you hear him speak today. So, the last episode, we scratched the surface on investing, right? We built a foundation about investing. And the topic, if you remember, was why invest? Why do we invest, right? So I thought, what better way to follow that up than to do an episode on investment philosophy. Do you have an investment philosophy? So I brought Jason on, interviewed him earlier in the week, like I said, and we had a great interview about investment philosophy, and he provided a lot of information, a lot. So I want you to hear this interview. Welcome to another episode of SurePoint Advisors Financial Roll Call with James Fay. We are 10-8 in service. This is a podcast for law enforcement by law enforcement. All right, today we're going to interview Jason Lamb. Jason is the CEO and founder of SurePoint Advisors. I want to thank Jason for taking time out of his busy schedule and welcome him to the podcast. Welcome.
Hey, James, how are we today?
I'm doing good, thanks. Jason, maybe you can tell our listeners a little bit about your career and how it led to becoming a financial advisor.
Oh, great question. I hope our listeners have a lot of time. So, believe it or not, James Fay happened to be my PT instructor at Monmouth County Police Academy back in 2003. I believe that's when we first met. Just for the record, I did gain a little bit of weight in the academy. So just want all of you to know that. It was a little easy back in 2003. So to this day, we still bust chops about it. But hopefully your brother's running a stricter show out at Monmouth County than what it used to be. In any event, I was with Wall Township Police for 11 years, and I started moonlighting, working in finance probably right around 2007, making sure that police officers were getting their estate planning done, meeting their wills, living wills, power of attorney, and making sure that they were protecting their family with life insurance. So I started originally working with a company called Guardian, a large life insurance company from New York City, and a broker-dealer called Park Avenue Securities. We've evolved over the years, so I think it went from about 2007, 2008 to all the way till February 2014 is when I took an early deferred retirement because we just happened to get so busy with actual money management and close to, I think at that time, about 400 households that we were managing. At that point, I had to make a decision of, whether it was going to be law enforcement or finance because I couldn't do both anymore. It started to, turn into Shawshank Redemption over at Walton Police Department. It would give me, a nice safe area of town to work and be like, okay, what are we doing for investments? And at that point, James, as you know, we were doing a few PBA accounts and, several police officers at that point.
Sure.
From there, obviously, took that early retirement, worked a few more years with Guardian Park Avenue Securities. And then in 2018, we had really formulated what is now SurePoint Advisors and became what is known as a registered investment advisory firm, which means that we have to act obviously in the full capacity of the fiduciary at all times for our clients, and we don't have any affiliation with any one company or broker dealer in the industry. So that's where we're at, and come a long way from, the 10 push-ups that it used to make us do in the Police Academy back in 2000.
Yeah, well, let me put the disclaimer out there that you can only go as fast as your weakest link. So you just happen to be one of the better recruits that we had there. So, put that to bed. But yes, we do fool around a lot here and joke around, which is great. Your vision over the years to see it come into fruition is just phenomenal, and I'm glad I'm a part of it. And I'm glad you let me be a part of it. So that's great. And as well as I do, I started this podcast back in November of 2020 to educate law enforcement officers in and around finance and different financial decisions that will come up in their lives and their careers and into retirement. So we touched on a lot of those topics that you said earlier that you touched on with your clients when you first started, your wills, your power of attorney, your emergency account, life insurance, stuff like that. So this is exciting today because in a previous episode, I finally decided to scratch the surface on a topic that we are very passionate about here at SurePoint Advisors, which is investing. And more specifically, I spoke about why we invest, So I thought I did a good job laying the groundwork and setting the foundation for investing. But I thought it would be a good idea to follow that episode up with the importance of having an investment philosophy. And too many times, we sit down with law enforcement clients to discuss their deferred comp or other investment accounts that they might have. And, we'll ask them, what is your philosophy? What is your investment philosophy? And after that long, uncomfortable silence, right, they'll finally break it by saying, well, to make money. And we both know that we've heard that quite often. And we have to kind of break it to these people that that's not a philosophy, right? That's more of a wish. So I thought it'd be great to touch on the investment philosophy, and who better to do it than yourself. It was that philosophy, I think, that we've grown to today that, it's part of your vision. So maybe you could start by educating our listeners on what investment philosophy is.
Absolutely. And what an appropriate time for this podcast. My first time in my career, this is the most that I've seen retail investors getting online and trading stocks themselves. So there's a lot of investing going on. And like you said, one of the first questions I have for our clients is, what is your investment philosophy? And I think in law enforcement, the best analogy would be an active shooter situation. And I know, James, you used to teach this, and I'm probably going to outdate myself a little bit with what that philosophy or strategy would be these days. But, I do recall if you come up onto an active shooter type situation, the number one thing that you are supposed to do is get to that threat. And a lot of times I'll make the analogy, as sad as the analogy might be, is if we go to a school shooter, active shooter, let's call it, and we get there and there's four of us. Let's see, maybe it used to be the T, right? And one guy trailing or whatever it might be now, a diamond, I'm not really sure, but what have you. But the number one thing that we're supposed to do was get to the threat. Now, emotionally, we may not necessarily feel that way. So if we walk by, the first classroom, and unfortunately we see the, 11, 12-year-old little girl who might have been, shot in the arm, reaching out for our help. Well, what do we want to do emotionally? Right? What do our emotions tell us to do? Probably stop and help that young girl out. Yeah, absolutely.
Sure.
But James, you taught us. What does our training and experience tell us what is best to do in that situation?
Yeah, our guidelines say we have to pass that and neutralize the threat, right?
Right. Because we're going to more or less save all those lives in the school rather than just that one individual. And I think really when it comes to investing, you have to have a very similar type of philosophy. It's not always going to be easy. Times are going to get rough. It just happens to be through the pandemic. There's a lot of stimulus out there. All market sectors are moving in positive directions. That's going to change. We know that. For every 4 years, there's 1 year that's down in the markets. If I was just talking to the S&P 500, 74% of the time since 1926, the markets have been positive. and on average, they've been higher than the negative returns on average, but we are going to see negative returns approximately 26% of the time. So we are going to see that. And the major question is going to be is what are you going to do and what is your philosophy to combat when it does get turbulent once again?
Right.
So great question. And a lot of times most people don't have a strategy. Or if I bought a stock at 100 and it goes to 200, well, what is your philosophy on taking profit? And I always advise that we should establish that ahead of time before you even make that first purchase of stock. Just like in that active shooter situation, you're training long in advance before when that event occurs. So I think that would be a good analogy for our law enforcement audience to compare it to.
No, I think that covers a lot of the questions that I had for you as far as, why is it important to have an investment philosophy, to stay the course, to take the emotions out of investing, right? Or, what type of thought process goes into developing an investment philosophy. So I think you pretty much covered that with that answer just to the first question I asked you. So I guess to follow those up, I would probably ask you to maybe give us some examples of an investment philosophy before we really get into what we do here at SurePoint Advisors.
Yeah, no, absolutely. There's a couple of schools of thoughts when it comes to investing. There's passive asset management, which means, hey, I'm going to go out there and buy the indexes. So, for example, you can buy the S&P 500 index, the top 500 companies of the United States of America. Sometimes you may have heard Warren Buffett say that and say, hey, leave it alone. And that's what's considered passive investing. And then there's something out there which is called active investing, which means that you're physically going in, doing research, maybe looking at charts and analytics of stocks and trying to pretty much predict the outcome or pick stocks that are going to outperform those indexes themselves. So we can get into that philosophy. And then there's what we consider factor-based investing, which we use here at SurePoint, which is purely based upon evidence and academics. So sure. I would probably say there's three major philosophies out there, and somebody's using some sort of those philosophies, or maybe they're using all three, or maybe they don't even know they have a philosophy at all.
Sure.
When we're looking
That's a great point. And I think a lot of them don't, right? I spoke to this in the last episode of how most law enforcement officers got involved in investing and then opening an investment account. And it's usually through either our field training officer at work or our supervisor who said, hey, kid, sign up for that. You need it. And pointed us in the direction of the deferred comp rep that was sitting in our break room or our shape-up room, whatever it might be. So, maybe you could just take a few minutes and explain what factor-based investing is and what we do here at SurePoint Advisors. I know you touched on evidence and academia, which is easy for our listeners to understand because as law enforcement officers, that's what we use every day to make decisions. So if you could speak to that, that'd be great.
No, absolutely. And I think this is why, we've all fell in love with the philosophy here at SurePoint because, again, as you mentioned, everything that we do is based upon academics and science. So we've been getting a lot of inquiries, for example, about cryptocurrency. There's money to be made in cryptocurrency, right? We just don't have enough science, academics, and historical data behind cryptocurrency to feel confident enough to invest our clients' money into it. My understanding of cryptocurrency is that it is right now self-regulated. So there's no official regulatory authority of cryptocurrency. So that's something that would be part of our philosophy is, okay, when we're looking at an investment option or an asset class or a commodity, or in this case, crypto would be currency, we want to see what the track record is. How has it behaved in the past? And do we have enough evidence to have what's called expected return moving forward into the future? Okay, so those are one of the things that we're always looking to do before we implement a portfolio. Now, the portfolios here that are built are based upon years and years of academics. So I can go into, some people, Harry Markowitz with the efficient market hypothesis, won a Nobel Prize, or Eugene Fama won a Nobel Prize in economics in 2013. So this isn't just shooting from the hip. Hey, here's a few stocks. This is the philosophy. So there's years and years of academics that have been built into the portfolios and the philosophy. And what's great about doing this and what motivates me to come to work every day is that it's evolving, right? So as we learn more and more, we're able to add to the evidence of our portfolio. And the longer that it's around, the more track record history that we have. So we here at SurePoint, I always make the joke is don't time it, factor it. Okay. And people look at me like, what's that mean? I'm like, okay, so we do something, again, I mentioned it before, called factor-based investing. We use what's called a 5-factor model. We do have a full-time portfolio manager. We do everything in-house here, who does have 25 years experience of institutional trading. So we are constantly looking at these factors. As a matter of fact, I'll get a little bit more into it, but we're shifting gears a little bit into one of our factors internationally and also in emerging markets. A lot of times you don't hear about these areas on the news or on Reddit. It's all talking about U.S. domestic stocks. So factor one, James, is we want to own stocks because historically stocks have historically outperformed bonds. Okay. And I'm going to back up a second too before I get into, well, why do we want to own stocks? Like, why do we want to take that risk? And the number one reason that we really invest is because we need to outpace inflation. Historically, inflation's been anywhere between 2 to 4%. Right now, it's been about 2%. So as you would all know, or anybody who's collecting a pension right now, there's something called a cost of living adjustment, right? That is no longer included in the pension. So each and every year that you collect your pension, your purchasing power of that dollar diminishes. So if you talk to some guys that have been retired for years, they're hurting right now without having that cost of living adjustment on there. So that's the reason why a lot of times we want to invest. And now we encourage law enforcement officers who have this pension to invest because they're going to have to supplement that pension that might be fixed for 40 years of their retirement. Okay. So that's one of the most important things that we're looking at, and how we do that is by owning stocks and or equities. Bonds, as you know, are there to dampen the volatility of our portfolios. Interest rates are historically low right now. Not expecting a lot of return out of the bond portion of our portfolio. And there is such a thing as safely going broke. So what I mean by that is, if your money is not at least keeping up with inflation, net of fees and also taxes, then you're literally safely going broke because you're losing the purchasing power of that dollar. Just a quick inflation example is I ran the dollar back in 2010, right? And what a dollar bought back in 2010 would cost you $1.19 at the end of 2020. Wow. My fear is that we have a lot of stimulus going on right now throughout the government, as all of us know. People are getting checks in their accounts from the government. There's PPP loans going on, right? So our deficit's growing to a very, very large number, which in fact can put pressure on our dollar, which can cause inflation. And one of the ways that we want to combat that or look at, the future is by owning equities. So that's factor one. Okay. Factor two is what's called the size effect. So historically, small companies, they call them capitalization, just a fancy word, meaning the size of the company. Smaller companies have historically outperformed larger companies, or what's called large cap stocks, over long periods of time. And we've taken this study all the way back to 1926. Now, a lot of times when we say small capitalization stocks, we think immediately penny stocks, right? Or like something really, really tiny. That's not the case. A small capitalization stock by definition is a valuation of at least 100 million, as high as 5 billion. But we do want to own those small companies in the long term, because every single 10-year period that you look at, we've pretty much seen these smaller companies outperform the large cap stocks. Okay. So that's factor two. The next factor we use is what's called the value effect. So for any of the women in the audience, or maybe even the men as well, when we go shopping and we're buying our clothes, do we ever want to pay full price, or are we looking for a discount?
Absolutely looking for a discount.
James, your wife would probably be pretty upset, right, if you went down to the shop, right, and you didn't have any coupons on Sunday or Saturday shopping, right? Where I know you guys.
That's right. That's right.
So
That's right.
The same thing comes in when we're looking at stocks. We're looking for good buys. Like, who doesn't want a good buy? We don't want to overpay for stocks. And historically, value stocks in 10-year increments have outperformed, let's call it, growth stocks. Now, very interesting times that we're in now, we're seeing the largest divergence between large growth stocks and value stocks that we've historically ever seen. The only time in history that was close to this was in 1999. And we know how that ended with the dot-com boom. So we do feel that it's very important to own those value stocks. And our fourth factor, we want to look at the profitability of a company. Okay, so I mentioned cryptos before. It's very hard for us to see the profitability of crypto because they're not making anything besides the Bitcoin itself, right? We want to see an actual physical company. What are they producing? What is their profitability? What are their earnings for the year? What's their balance sheet look like? Okay, and we want to work with only those stocks. So for an example, smaller companies are going to be the first ones that probably don't make it through times such as the pandemic if they don't have a strong balance sheet, right? So what we want to do, for example, in the United States of America here, we have what's called the Russell 2000. That's the index that represents the smallest 2,000 companies, right, between 900 million and 5 billion. Well, we want to own all 2,000, right? Because we want only focusing on the most profitable ones. So for an example, in our portfolios, we own approximately 840 of those stocks, and we actually filter out those non-profitable companies. Okay. And then that will turn us into the fifth factor, which is called the momentum factor. And there's a lot of momentum going on right now in the market. But what momentum says is a stock that's doing well tends to do well for the next following 6 to 8 months. So we want to own those, exploit the investor behavior who keep driving those prices up, but then we want to take that profit from those momentum factors and redistribute that into parts of the portfolio that are on sale, such as value or potentially maybe smaller type companies. And then we would also even look at international markets and emerging markets. So all very, very important when you're building a 5-factor model. So this is my favorite thing to do. As you know, I could talk all afternoon about this.
Yes, you can.
A lot of times when I have somebody who signs up for the deferred compensation plan, I'm like, is there factor portfolios available to you? And they look at me like I got 6 heads. So a lot of times it's like, well, just like you said, my sergeant said Nationwide here or Access here or whatever company might be that provides this VALIC, something like this. My sergeant said I should sign up for this and save money, and great. Everybody has good intentions. The most important thing is that you're saving, but nobody's really looking under the hood of some of these programs, meaning how does the advisor get paid? What are the expense ratios in the portfolio? What's my diversification look like? Or how do I pick the mutual funds inside of this plan? So a lot of questions that, you might have and you might guess at, or you might do something what's called track record investing. So 3 rules that we have here at SurePoint. And again, there is no silver bullet to investing. These are just our rules. They're not set in stone. But we don't like to stock pick. We don't like to market time. And then we don't like to do what's called track record investing. So track record investing is when, you get the statement of mutual funds and you're like, okay, well, over the last 10 years, the U.S. large cap growth has done 25%. And James, I'll ask you this. What do most people do?
They pick that. They market time, right?
Yeah, they pick the 25% because our emotions say, well, why wouldn't I pick that? Because that's done the best, right? Mm-hmm. But there's truly no indication that that's going to do the best for the next 5 years. And unfortunately, a lot of times, because it has done so well, where are you buying that mutual fund? At a high or a low?
Well, most times you're going to buy it at a high.
Yeah, of course, you're buying it at a high. And in the rules of investing, where do we really want to buy?
You want to buy low on sale.
Yeah, and we want to sell
high.
Exactly. So a lot of times we know the rules of the game, but we may not necessarily be following them. Or we might be doing something that we feel is good just because we may not know any better about track record investing. So our main job is to educate clients and police officers and whoever else it may be who's involved with investing about just making informed investment decisions before they actually make them. So
absolutely,
that's where we want to have our.
let me ask you this, Jason. Is there something that we have in place here that will take the emotions out of investing, that will help them to, their portfolios to, sell high and buy low?
Yeah, it's a great question, and I know you have another podcast all set up for this. And what James is referring to is what's called rebalancing a portfolio. So, James, if you want to maybe share the screen with me, I can visualize this out for our audience of rebalancing a portfolio. And I'm just going to use a portfolio example, 75% stocks and 25% fixed income. So for an example, if you had 75% stocks in your portfolio for the year 2020, we all know that markets did very good. So in that case, you're 75-25. I'm just going to draw up my little pie graph here.
For our listeners that are just listening and not viewing this on the YouTube channel, you can explain this to them, Jason.
Yep. So right now I'm just drawing a circle graph, and I cut out 25% of the pie, which is going to be our bonds, and the other 75% of our portfolio, which is going to be in our globally diversified portfolio of stocks. Now, in 2020, what has happened, right, because stocks have done so well, if you had just left your portfolio alone, all of a sudden 75% might become 85% by pure math because it's grown. It's almost like sitting at the blackjack table, you're winning, and you have a lot more chips than what you started with. But if you pushed all those chips out onto the betting table, you're taking more risk than you had originally intended. So we want to help clients have that philosophy of taking profit and having a systematic way of taking profit in the future. So in this instance, a 75-25 portfolio, again, by pure math, has become an 85-15 portfolio because the bonds haven't really moved. So here, we want to take profit. And we do this throughout the year, managing the portfolios. But in this case, we would want to sell off that 10% profit, right, and get that back down to our 75% stock allocation. And we would take that 10% profit and park it into the bond section of the portfolio where it's actually going to be more or less safe and get it back to 25%. Now, one of the things that we would do in a down market, so let me just clear this for you guys, is we also want to rebalance. So when markets go down, what do most people do, James?
Markets go down, most people sell. Most people take their money out.
That's right. So in this case, let's say that the market, we'll call it March of 2020.
Okay.
Our 75% stock allocation dropped to 65%, and our bond allocation, right, by pure math, actually went up to 35%.
Okay.
So when everybody's running from the market, right, because it's crashing, our philosophy is, hey, we have too much in bonds. Let's buy the stocks on sale so we can get back to our original 75-25 allocation. And what this forces us to do is sell high and actually buy low, which is extremely difficult to do from an emotional standpoint. So I think one of the most valuable things that we do here is help coach clients through all these difficult times and turbulent times that they're most likely going to go through in their lifetime. You know, it's not uncommon to see for, you know, let's call it market crashes or a bear market, which is by definition 20% or more of a drop in a 10-year period. It's very common. We anticipate it. It's coming. Let's be prepared for it. So we definitely want to have a philosophy to be prepared for that. And I think when markets do crash, our clients do a really good job of staying the course because we spend so much time with them up front of having that plan. And I'll just revert back again to, hey, why would we be so successful during an active shooter event? It's because you take so much time to train and prepare for that event.
Exactly.
And I don't think it's much different when it comes to your investment philosophy. As long as you're trained and you're prepared and you know what you're going to do, you will be just fine. A lot of times people come see us, and if they don't have a 5-year time horizon, James, you know this, we're turning them away because we just don't have enough time. I don't know what can happen in 5 years. Or we have to be a very conservative, but they should certainly not own 100% stocks if they don't have any longer than 5 years.
Right.
So having the appropriate asset allocation, stocks versus bonds, and also identifying your time horizon is very important when it comes to identifying your investment philosophy.
Right. All right. Well, listen, that was extremely informative and should certainly educate the listeners. That was a lot of information, and you hit on a lot of topics that we're actually going to cover in the future on separate podcast episodes. I think that would be important. So this was just a general overview of investment philosophy, and you really covered a lot of information. You are a wealth of knowledge, Jason. You really are. You could tell the passion you have when you speak. I know firsthand from coming in this office every day that that you really love doing this job and love helping people and educating them about not only the investment philosophy or investments in general, but the whole financial plan, which is great. So you are certainly an asset to, not only the law enforcement community, but the community in general, anybody that really steps into this office. So again, I want to thank you for your time and expertise on this topic, and I want you to stay safe and be safe. And again, thanks for imparting us with your knowledge.
Oh, absolutely. I love to do it and really appreciate your kind words. That's what motivates me to, keep coming in and doing this. So, anytime that we can help somebody, it's just as rewarding as if you help somebody in an auto accident or, when you were on the job. So it is just as rewarding to come here and work with such a great group of people. And I think too, James, if anybody has any further questions, we can share with them. We do have a brochure that we publish every year with updated numbers called the SurePoint Advisors Financial GPS. So maybe we could make that available, or if anybody who wants to reach out to you, we can provide them a free copy of that.
Absolutely, and I'm sure we could talk about that GPS brochure on another episode too of this podcast, which is great. So I wish I could have motivated you that well back in 2003 to do those push-ups, but you've come a long way. And again, thank you for being on this episode of the podcast, and we'll talk to you later.
Sounds great. Thanks, James.
You got it.
So again, that was a lot of information that Jason provided us. It was very, very informative. And again, it built on why you should have an investment philosophy. So 10-11, prepared a copy. Let's go over a few takeaways that we learned today from the interview. So an investment philosophy is a set of beliefs and principles that guide an investor's decision-making process, right? And investment philosophies are one of the defining characteristics of people or firms that manage money. So here at SurePoint Advisors, again, we have an investment philosophy that we use. And Jason spoke to that during the interview, right? Most investors who achieve long-term success develop and refine their investment philosophies over time and do not frequently switch between philosophies as market conditions change. So they're not market timing, they're not gambling, they're not speculating. They have a philosophy and they stick with it. And long-term investors have been getting rewarded, okay? So investment philosophy should include certain things. Let's talk about them. It should include the investor's goals. What are your goals? What are your goals for investing? It should include their timeline or their time horizon. How long do you have until you need this money, right? Until you retire or you want to get to this money. It has to involve your risk tolerance. How much risk are you willing to take? It's like a risk versus reward thing, all right? And then their individual capital status or needs. What are their needs for this money, right, in the future? Jason spoke about the different types of investment philosophies, and there are numerous types of investment philosophies. Here at SurePoint Advisors, we believe in the factor-based investing. We use the 5-factor model, which is based on evidence in academia. It's very easy for my law enforcement listeners to understand, right? Everything you do, every decision you make during your workday is probably built on evidence in academia. So it's easy for us to teach it to our law enforcement clients as well. So historically, over long periods of time, we know that stocks have outperformed bonds or fixed income. Small companies have outperformed large companies. Value companies have outperformed growth companies. And we look for profitability and momentum. Jason went over all of those 5 factors. And again, that's factor-based investing, and that's our philosophy here at Short Point Advisors. Jason also spoke about rebalancing and the importance of rebalancing. There was a lot of information in this podcast, and we're going to use this podcast to break down that information in future episodes, where we can pull certain topics that Jason spoke about today and do a whole episode on that topic. So I want to again thank Jason for his time. I know firsthand how busy he is. Not only does he meet with clients, but he handles almost all the back office work here at Short Point Advisors. The guy is a wealth of knowledge and truly sleeps, eats, and breathes this stuff. If this episode has you wondering if you even have an investment philosophy, you can call me in the office at 732-876-3777. Listen, you take your car for an oil change every 3,500 miles. So when was the last time that you had your investment portfolio looked at? With that, this has been another episode of Short Point Advisors Financial Roll Call with James Fay. We are 10-7 out of service.